Ask yourself this: what if you could add a free, simple, but powerful tool that gave you a winning edge to generate consistent trading income? A tool that could significantly increase your probability of winning trades. Now, that's why when I thought about something I could give every trader for free that's really valuable and that would truly help you more than anything else, I thought of teaching you how to capitalize on this simple but very powerful option tool that's absolutely free and that you can start using today. Now, you may already be using this tool or know how to use it, and if so, I hope to further your use of it in this guide so you can become a better trader, an expert trader. Not only can this information be used to help you generate more option trading income, but not using this tool can lead option traders to the number one trading mistake, which I want you to avoid. Knowing what not to do can be just as important as knowing what to do. So I'll show you that too in this short video. Option trading has many more advantages than trading stocks, but it's a bit more complicated. And for the individual trader, options can be a little intimidating as well. Now that's why many investors trade options by purchasing out-of-the-money options, often short-term options, since they cost less than long-term options and it's a simple strategy. For example, out-of-the-money calls, that's where strike prices above the stock price, are especially popular because they are cheap and seem to follow the old Warren Buffett paradigm we all love. Let's buy low, sell high. But is this always the best option strategy? Imagine you're bullish on Facebook and it's trading at $100. As a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike price of $120 at a cost of 15 cents, which is $15 per option contract. Now why? Because you can buy lots of them. So let's do the math. Purchasing 100 shares of Facebook at $100 would cost $10,000. But for that same $10,000, you could buy 666 contracts of the 120 calls and control 66,660 shares. Wow. Now just imagine that Facebook hits 121 within the next 30 days and the 120 calls are now trading at $1.05 or $105 per option contract just prior to expiration. You do the math and you can make $59,940 in a month on $10,000 of capital. At first glance, this kind of leverage is awesome. But don't let this glitter fool you, because not losing money is just as important as making money. One problem with short-term out-of-the-money options is that you not only have to be right about the direction the stock moves, but you also have to be right about the timing. That ratchets up the degree of difficulty. To make a profit, the stock doesn't just need to go past the strike price, but also must do so within a defined period of time. In the case of the 120 calls on Facebook, you need the stock to reach $120 within 30 days to make a profit. This dual objective of having to be right on direction plus on timing really lessens the probability of an option trade being a winning trade when buying options. And everything I teach my clients is based on managing risk and increasing the probability of your winning trades. In this Facebook option trade, you're wanting the stock to move more than 20% in less than a month, and this would be like a 2 standard deviation move. How many stocks are likely to do that? Well, not many. In all probability, the stock would not reach the strike price, and the options would expire completely worthless. So based on probability, using standard deviation, there's only about a 5% chance for this stock reaching 120 to 121 by expiration. So in order to make money on out-of-the-money options, you need to either outwit the market or get plain lucky. Being close means no cigar. Imagine Facebook rose to $110 during the 30 days of your option lifetime. You were right about the direction the stock would move, but since you were wrong about how far it would go within a specific time, you'd still lose, and this is outright painful. So based on this trade example, a better goal for every trader, in my opinion, would be to select trades based on what provides the most consistent positive returns, not a one-time big winner. And consistency is derived from making high probability trades based on reliable data and facts. Where there's a big disadvantage such as the one you saw in this option buying scenario, you can usually just look at the flip side of the coin and see an equal and opposite advantage. In this case, being a seller of options gives you a huge advantage over being a buyer of options. All the pros know this and take advantage of it, and so can you. So as a seller, all the things you saw in this example are the same, but are in your favor instead of against you. This is why the professional traders look first to take advantage of selling options for profit generation and hedging. By selling an option, we're in essence selling time. What a powerful dynamic. And it's a strategy that's yours for the taking. An option is like a coupon that must be redeemed by expiration date or else it's no longer valid. But how is this done and what is involved? The most important option factor for income generation is understanding the concept of time, and that's pretty simple as you just saw. Time value is used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. Option income strategies are very tied to time value and the impact that it has on the price of an option. It's that simple, and you can use this information to make money. Time value, the extrinsic value of an option, is the premium a rational investor would pay over its current exercise value, intrinsic value, based on its potential to increase in value before expiring. This probability is always greater than zero, thus an option is always worth more than its current exercise value. So let's take a look at the following chart to see just how predictable and powerful this option time paradigm is and answer this simple question. This chart illustrates time decay, and when you look out 120 days to 90 days out, the time decay is very, very small, very, very slight as it starts. And then as you get further in, closer to expiration day, it really accelerates. And I call this turbo time decay. And before you know it, your option could be worth zero based on that time decay. So if the underlying security price was to go sideways, having no directional trend, would you have wanted to be long an option 120 to 90 days out, or would you have rather sold an option? Now, while there's some slight variation, this is the common natural time value progression for all options, and it's seriously like falling off a cliff blindfolded. The free tool for determining the actual time decay of an option is called Theta, which is provided on your brokerage platform. Theta helps you to know how much an option premium is decaying each day. For example, a theta of minus 0.01 indicates the option's premium is decaying by $1 a day. Of course, theta changes over time and increases the closer the option gets to its expiration date. So you can see how important this data can be for option traders. And that's it. Simple but very powerful when used correctly. Here's how to use this information. Now, if you own an option right now, check the theta to see how much your option is decaying each day. The following is an image of the theta display from the thinkorswim trading platform. Getting theta usually involves just a simple click on your brokerage platform. So in this example, you can see Apple, and you can see days to expiration right here is 10 days. Now, if you come down to strike prices right here, and you come down to the 114 strike, and you come over to the call side right there and look at theta, you can see that the theta value is minus 0.06. So that basically says that that 114 strike is going to go down each day by 0.06 cents or $6 a day per one option contract. So you see how you can increase your skills using theta as a seller of options to stack the probabilities way in your favor when generating income by selling options instead of paying for options. The most common strategy is selling options, naked calls or puts, but this is an unhedged strategy. You can easily reduce this risk or hedge it by purchasing long options to offset the unhedged risk from selling options naked. While hedging reduces overall returns, it's much like having insurance, and it's worth that cost for risk management. Selling options takes advantage of time decay, and there are a number of really great option trading strategies that can generate consistent income with limited downside risk. Returns can still be significant even with hedging protection, since many option strategies such as a properly constructed credit spread can have a probability of over 70% even without aid of technical analysis. which can then increase your winning probabilities even more. The most popular hedged option income strategy that can be used regardless of market direction is the credit spread. This strategy takes advantage of time decay to make money while also reducing risk. You may be wondering how to select the right income option strategy. The goal of every trader should be to select trades based on what provides the most consistent positive returns and not always the greatest. And one of the best ways to achieve this is by knowing the income option strategies that are available and then selecting the one that is best for your trading style, trading plan, and lifestyle. Types of income option strategies are the covered call, calendar spreads, diagonal spreads, long iron condors, and credit spreads. My favorite income option strategy is the credit spread for 4 reasons. It can work regardless of market direction. It almost always works even if you're wrong. The probability is over 68% even without adding technical analysis, which increases probability even more, and it's perfect for hedging. To back up just for a second, the probability is over 68% if selling out of the money options. So in this situation, you're looking to sell a 1 standard deviation out of the money option, which will be discussed a little bit later. There are 3 types of credit spreads. You've got the bear call credit spread, bull put credit spread, long iron condor. Bear call credit spread is best if you think the market's probably going to go down. The strategy is selling 1 call with a lower strike while simultaneously buying 1 call with a higher strike and in the same month. The bull put credit spread is best when you think the market will probably go up. This strategy is to sell 1 put while simultaneously buying 1 put with a lower strike in the same month. The long iron condor, it's known for being a non-directional low risk trading strategy. This strategy combines the bull put credit spread and the bear call credit spread together. Let's review what you've learned in this guide. You can sell options with a much higher probability of success than you can buying options. Data is a free tool on your brokerage platform that you can use to check time decay. Selling option strategies can be hedged or not, but hedging lowers your risk and slightly lowers your return. Credit spreads are a popular income generating strategy that capitalizes on option time decay with controlled and limited risk. Would you like to learn more about these option strategies that capitalize on time decay? You can do that now. To learn a whole lot more on this, you can get my free Money Making Trading Option ebook plus weekly access to my trading videos completely free. So this will get you on your journey or your road to start being a successful option trader. So just use this link below or click on the link provided for you. Good luck trading and to your success.